We can see yesterday the market closed fairly red right across the board, but what happened after that is what we want to discuss, where many names reported their earnings. We're talking Microsoft, Google, as well as others that we do like to keep our eye on, but under the spotlight today is in fact Meta, and for quite some good reason. This company in the pre-market and even after they reported their earnings is down around 9%. So we want to uncover a few things. Firstly, why is this company down? And secondly, should we consider buying this dip? Now look, over the last year and year to date, this company has performed very strongly, and over the last 10 years, it is a respectable one with massive outperformance against the S&P, but we're going to see this now move towards the midpoint of the 52-week range, and we can note that Wall Street themselves see this as a strong buy. That was before they reported their earnings, with Seeking Alpha giving this a respectable buy of 4.1 out of 5. Now, as you can see, they reported their earnings, and your eyes will be drawn to the huge miss on the EPS. They reported just over $1. Expectation was $6.67. Huge miss. 84%. Revenue, in fact, was a nice beat by around 4%, something you do expect from Meta. As we've shown before, historically this company does beat on both headlines, and actually the reason for this large miss was a one-time tax charge. If you strip this out, they would have actually massively outperformed on the EPS. And we can see here the reason for this one-off tax charge was put down to Donald Trump's One Big Beautiful Bill, which meant they had to take a one-time non-cash charge. But it wasn't only that that's getting investors a little bit worried, is that they're starting to increase their expenses. We can see that they expect their total expenses to significantly increase into 2026, and this is now what investors are starting to get worried about. Before with Meta, we actually saw the opposite. Revenues were increasing, expenses were decreasing, and now if they're going to continue to increase at a very rapid rate, investors are struggling to see whether or not they will get a nice return on all of this money, and this is pretty much the point that is capturing the headlines. Yes, there was a one-off expense charge which did impact the EPS, but if it was just that, probably investors wouldn't be as worried as what we're seeing now. But bigger capital costs, with Mark Zuckerberg looking to continue with very aggressive AI spending, something that only continues to increase every single quarter. We can see on a trailing 12-month now, September 2025, the quarter just gone, they've spent $63 billion, and they've also raised the lower end of their total expenses for $2 billion, anticipating now for the full year 116 to 118. That is a significant amount, and as an investor, if you're looking at this, you want to see that the money they're putting into the business, that they're going to get a return down the line. That is what is giving investors stress right now. And there's also something worth pointing out, that their guidance for the next quarter is pretty much in line with analyst expectations, where they're anticipating around 56 to 59 billion. So the main issue we're seeing right now is this increase in expenses. So you need to consider, as an investor, is this something that's really going to turn you off from Meta Platforms being in your portfolio? Maybe one in which you're considering to add, or just hold for the time being. And if we do look at their earnings in a little bit more detail, revenue itself is up 26% from the same quarter last year. Very strong. We do love to see this. There was no efficiencies to their gross margin. Little bit disappointing to see. Operating, we actually got a deficiency where in fact it decreased 3 percentage points. And we note here their bottom line, although largely due to that one-off tax expense, was down 33%. As we said, if you were to strip this out, they would have beaten on the EPS overall, so actually a double beat, and that is why much of the focus from investors and analysts right now is the increase in expenses rather than the EPS miss. And we can see that overall their operating profit does seem to be tracking in the right direction, although you will notice it hasn't been even one single quarter where Realty Labs has in fact turned an operating profit, yet this is one that they still continue to put money into. And if we look at it in fact from a trailing 12-month basis, September 25, most recent quarter, their operating income has been increasing at a CAGR, that is compounded annual growth rate, of 30% every single year. So look, underlying metrics do look good. We will cover them in a bit more detail. And another thing that we can see, which is very impressive, they're increasing both in fact the price of their advertisements as well as their impressions at a double-digit rate. We can see 10% and 14% respectively, which is great. Yes, they have seen the numbers at a higher rate. In fact, we're seeing a lot of improvement on the prices of their ads. They're starting to increase, which just a few years ago they were actually reducing the price. And as we said, if you do strip out that one-off expense, they would have beaten by around 58 cents, meaning over the last 4 quarters, Meta have a 100% track record. Now look, over the next 4, in terms of earnings per share growth, it isn't actually expected to be a lot. We're talking in the low single digit. One thing we would say though is just look at history. They do seem to outperform by quite a significant margin. Now we're going to get into their valuation, but the expectation is for the next full year EPS to sit around $30, which in fact before this near 10% drop would have meant a forward P of 25. And at the end of yesterday, their forward P was sitting at 26. That is above the 5-year of 23. Now, in fact, after the price drop, it will be sitting around 24. So now we're talking about a company, Meta Platforms, that will be trading in line with their 5-year average. And if we were to look at the blue tunnel, which is always for new investors, highlights the expected intrinsic or fair value, it was just sitting outside. Now with the price drop into the mid to high 600s, it will be sitting around the middle point, meaning Meta Platforms on both accounts does look reasonably valued. It is not at the severe undervaluation that we saw during Liberation Day, where it did drop in fact below the bottom end, but as of today, it is looking like when the market opens, it will be in a reasonable level. And as always, make sure you're subscribed, notification bell is on, because when high quality companies do slip into a severely undervalued position, we will highlight and let you know. And if we zoom out over the last 10 years, just to reflect on Meta overall, you can see there was many instances where this company has traded severely undervalued, which tells you pretty much that this one very rarely in fact does trade at a premium. In 2025, we have seen this a few times, but going back in fact over the last 10, it has, if ever, just once during 2021. And speaking of valuation, where they get an F, you can see they do trade at quite a significant premium to the sector overall. Although worth flagging here that in the sector there are a lot of low quality companies, so probably what's more reasonable to look at is in comparison to their 5-year average, which as we said, after the drop that we're seeing in the pre-market, will pretty much be sitting in line. Even more importantly, for those that like to look at a price to earnings growth, below 2 is what we want to see. That is what we get. Again, for consistency, we will flag it is 10% higher than the sector. With the drop, it's going to be in line. And their 5-year average of 1.55, meaning right now you're paying an 11% premium. But as we're saying, given the price is dropping, this one on both accounts is now going to be sitting in line with this average, trading at a PEG around 1.6. And if we just reflect on the 2 valuation metrics against the S&P, overall forward Ps are looking very expensive, lots of red right across the board. When we take a look at Meta Platforms, trading around 25, will drop to around 24 upon market open. You can see it doesn't look too bad when comparing it against others. And the same to be said on a PG basis. 1.6 is probably going to be where it sits when the market opens. We can see there is a lot of red right across the board, so potentially an opportunity to consider. Although it is one that many analysts after their earnings have started to lower their price targets. We have one here dropping it down to $840. But bear in mind their growth is very strong. Whilst they get a B-, they grew top line 19% last year, expected the same this year, well above the sector on both accounts, and also not too dissimilar from their 5-year average. So like a lot of growth companies, we're not seeing Meta Platforms slow down by any means. The same to be seen when we look at the EPS over the next 3 to 5 years, projected 16%, above the sector at 11 and only marginally below their historical 17.1. And we'll also flag profitability looking absolutely exquisite, an A+, gross margin 82%, well above the sector at 54. Nice little improvement to their historical average. And the bottom line, look at that, 40% net income margin. So for every $10 of revenue this company gets, we can see $4 hits that bottom line. That is something incredibly rare to see, and it's also significantly higher than the sector, massive improvement to their 5-year average of 31%, where their cash generated from operations over $100 billion. That is a huge improvement from their 5-year of $63 billion. And we do like to have a quick sneak peek at what institutions are doing with their 80% ownership. They sold $65 billion worth of shares in the last year. They bought a lot more, nearly 3 times as much at $182 billion. And in fact, what's even more important that we want to flag is that in the most recent quarter, they actually sold more than they did buy. Net sellers, 2.8 billion selling versus 1.9 buy. Very rare to see, because if you want to see where in fact they sold more than they did buy in the last few quarters, you would in fact have to go before Q3 2022. So maybe something just to take note of. Very rare, but in fact institutions in this quarter are net sellers. And it's not only them, insiders with 14% ownership, no buying, but we do get around 855 million worth of selling. 3 million in Q4, 177 in Q3, and 94 in Q2. Now remember, as always, worth highlighting that insider selling isn't typically a bearish signal. They sell for many reasons, personal and financial. And on the flip side, when we take a look at super investors to see what companies they have in their portfolio, well, the third most held stock in that is Meta Platforms, where 28 super investors hold this company overall. So maybe will be interesting when we get their filings for Q3 to see whether they've been buying or selling. We will flag this very soon, so again, make sure you're subscribed. You may also want to know how the company's performed against the S&P and the QQQ. Now, over the last year, it has outperformed the S&P, pretty much been in line with the QQQ, but if the pre-market drop does hold, it will in fact have underperformed in the last year against the QQQ, but still slight outperformance against the S&P 500, where when we do zoom out over the last 5 years, again, conclusion is very clear. It has outperformed, not massively, but against the QQQ, big outperformance against the S&P 500, which was up 108 in comparison to Meta's 169. And over the last 10 years, that is really where you see that outperformance shine. Meta up 606, QQQ up nearly 500, S&P a lot lower at 228. So you would have done really well holding this over the last 10 years. But as always, past performance is not an indicator of the future, so let us know whether you believe they can keep up this strong performance. Maybe you're looking like this as a buy the dip potential. And then we look at their underlying metrics, kicking off with the free cash flow. As always, earnings data is available but susceptible to manipulation by management through accounting, so we do tend to ignore. We want consistent growth over the long term. That is what we get for the large part. Do note that over the next year, it is anticipated to drop. Bear in mind, capex spending is very, very high, which will impact those numbers. Sales growth, double digit nearly every single year, bar 2022, where it was a minus 1% drop, 19% on a trailing 12-month. Expectation is that we will see the continuation of the very strong growth. We'll cover sales shortly. Shares outstanding. Now bear in mind, they have recently introduced a dividend, but another way they can return excess cash is through share buybacks. Something we've seen not that much from 2015 to 2021, but since then they have been doing a little bit, very minimal, but as an investor you could look at this as perhaps a nice added bonus. ROIC, very, very strong. This is one of our favorite metrics. 10% or more. Give us faith. Management are able to effectively allocate their capital. Gone from 10 years ago, now sitting at 25. So great to see. Margins, as always, high quality companies will in fact show efficiencies. Very inconsistent, but if you look at it from a 10-year standpoint, 35 in 2015, now at 43. Good to see. And free cash flow, also very inconsistent, but still showing some very strong numbers. 29% on a trailing 12-month is also respectable. Then we get to the net debt to EBITDA, the final metric here, and probably one of our favorites alongside the ROIC. Below 3 is what we want. Numbers you see below, or lack of, number of years it would take Meta to pay off all of their debt, net of cash on hand, and correlates to the balance sheet strength. 0 pretty much across the board, very minimal on a trailing 12-month, telling us it won't even take Meta Platforms 1 day to pay off all of their debt, net of cash on hand. The other thing is a quick income and balance sheet review. Now look, as always, top line does typically tend to grow for most companies. Meta 18 billion, now sitting 10 years later at 165. But as always, we want to understand the net income. Do we get that consistency on the bottom line? And the answer is, for the most part, yes, we do see an increase. Around 4 billion 10 years ago, now sitting at 62. Great to see on a trailing 12-month increase is very nice. So the expectation will have another very strong year in 2025. Where the other thing is a quick health check, total cash versus total debt. 18 billion 10 years ago, now sitting at 47. Just look at that massive drop though from the previous quarter, telling us they are spending a lot. We're already hearing that anyway. And one number will not give anything away here in this review, so we compare it to their total debt numerically and directionally, which has in fact also been increasing. That is something we were expecting anyway, given the earnings commentary, not just this one, but over the last few years. 300 million 10 years ago, now sitting at 50 billion. So cash and debt, in fact, aren't too dissimilar. That is why the net debt to EBITDA is pretty much around zero, but definitely something to keep an eye on. With cash decreasing, debt increasing, not something you really want to see, so maybe we'll consider a little bit extra for our margin of safety as well. And before we jump into our valuation, just to let you know, we have released our latest free weekly article. We drop one every single Sunday morning to your inbox, covering severely undervalued stocks, as well as what's gone on in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to October's severely undervalued stock list. Lots of information for each one, the upside that Wall Street themselves see over the next year. We will be dropping November's copy in the upcoming days, as well as a list of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now our intrinsic value gets to $800, derived solely from the discounted cash flow model. As you can see, we have a growth rate kicking off at 12%. Now that is below the average of 34 and the 2024 year, so you could say we're being conservative, but we have put that as the low rate, with medium and high coming in at 14 and 16 respectively. As always though, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Meta or any others. Now first things first, on a reverse DCF, given the price drop to 685, 9.8% growth is baked in to the future free cash flow. Straight away, if you believe that is very low, then you may see this potentially undervalued. If you believe it's too high, Meta will not grow its free cash flows that fast, then you could see this as potential overvaluation. So now if we use our growth rate at the lower end of 12% with the discount rate, we get the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, giving us $800. That is 17% upside. Now you may look at that as very conservative, so if you want to use the middle rate, which is what we typically do at 14, intrinsically 921, 34% upside. And if you want to see this at 16%, well, over $1,000, 55% upside. Now let's use the lower rate to start things off, because we're not done there. We want to understand what is the margin of safety on offer to investors today. And typically we kick off with 10%. We execute buy if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. And if you believe that today, it's a buy up to $720. But what our model is already flagging at this level, if you believe the growth rate of 12% to be most appropriate, then in fact you are getting a 14% margin of safety. If you want 20% in terms of an MOS, well, a buy up to $640. If you want 25, then a buy pretty much on the $600 mark. Wall Street themselves see this at $880 into next year. That is upside of 28%. But let us know your views on Meta platforms, whether you see it as a buy, hold, or maybe a complete avoid. And the other thing we'll do is we'll highlight, for those that want to see the medium rate, 14%. As of today, you're getting pretty much bang on a 25-26% MOS is typically where we would say to dollar cost average, but that is on the assumption you believe they can grow their free cash flows at 14% over the longer term. If you also just want to see at the higher rate of 16, well, intrinsically very high, 35%. As always though, let us know your views. Is Meta Platforms now after the drop a buy, hold, or maybe sell? And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.